Fairleigh Dickinson grad.
Yes, MBA at Fairleigh Dickinson. I started at Baruch College, but then I moved to New Jersey, so I started going to Fairleigh Dickinson because it was a lot easier. But I never thought we had a basketball team, to be honest with you.
That was what I was going to ask if you follow along at all.
Well, yeah, I was impressed to see them win against what was it, Princeton? No, was it Princeton?
No,
not Princeton.
They took down a #1 seed.
It was a #1 seed, yeah.
Second 16 to do it.
Right, and then our second favorite team is St. Mary's, because we used to live in Moraga, so they got blown out too. But they made it at least to the show.
Speaking of St. Mary's, that Gonzaga kept me up till about 12:30 my time last night, just with this great finish with UCLA.
Oh, did they beat UCLA?
One point. It was the final minute and 20 seconds of the game took 19 minutes.
I bet John Wooden was upset.
He would not. Yeah, it's been a long time since they've racked up 70+ wins in a row.
Tom, I appreciate you bringing Guy and me together. Guy, what's with the Mod Squad side?
I'm trying out for my Elvis. Having moved to Las Vegas, I'm going to try to be an Elvis impersonator. So that's look, nobody else is doing it. I'm being a trendsetter. I'm going to go on TikTok, and now you're going to see everybody's going to have the long sideburns. So I'm auditioning them.
Well, it's part of my staple, but you got better looking chops than I do.
It really slows down your shaving, I have to tell you, because in order to make sure you get that good line or not nick the corner, it slows me down a lot. But anyway, you also have to.
Do you know where the name Sideburns came from?
Comes from Burnsides. I was on a movie that I watched, Blackbird. I don't know if you've watched the movie Blackbird on.
Well, he was a Civil War general.
Right. Exactly.
Anyway. Oh, Fairleigh Dickinson beat Purdue. All right, here we go. Rock and roll.
All right.
Here we go. Well, welcome everybody in. Latest edition of the Rundown today. Tom Gallucci here, as always, joined by our esteemed co-host Rob Chrisman. And welcome to the Sideburns aficionado episode of the Rundown here. Pleasure to have longtime viewer of the show, Guy Schwartz, with us today.
Thank you.
Thanks for joining. Top producing sales manager, longtime originator, currently with
former top producer. Let's keep the record straight.
Please do.
I wouldn't say I'm top producer now. No.
Also, Fairleigh Dickinson alum, so a lot of kudos in the chat about their huge upset over Purdue the other night. Obviously, want to welcome you into the show, and Rob may be ready to rapid fire some questions at you, so I don't want to leave him on standby for too long here.
All right.
And so, Guy, we've got about 27 minutes left. I do have questions for you. Guy, eyes up here. What are you looking at your notes?
I was going to, go ahead.
Yeah. So first of all, let's establish some ground rules. So we are here. You're going to be answering the questions. You're not going to be asking me about why is the 10-year disconnected from the 30-year mortgage rate and all that. We can talk about that. But in general, it's rare that we have an actual live originator on the show who is as knowledgeable and experienced. And you can poo-poo that all you want, but when I think of very good originators who have their clients' interests, front and foremost, I think of you, and I think of you in terms of being able to craft a loan or cobble together a loan and make a deal work. And you've been doing this for decades.
Sure.
And I wanted to ask you, just in general, we've seen these business cycles, we've seen rates going up, rates going down, yada, yada, yada. And I know business is slow right now, almost across the board. And any client or any company who says, oh, we're going gangbusters, I think is not telling the truth. What is the general climate out there, the psychological climate of borrowers or potential borrowers out there? And we could talk about purchases first, if you like, and then talk about people. Are there any refis? But let's talk about clients that you know of who are thinking about buying a home. Where are their heads right now?
Well, their head is still back in the 3.5% interest rate scenario. And, to throw out a number like 7, which we were throwing out, it was quite shocking, not only to them, but to myself. But, I don't want to sound cliche, but I'm going to be a little bit cliche and, marry the house and date the rate. I have to tell people that, unfortunately, or fortunately, because the rates are high. I mean, we're in the mid 6s, maybe we're in the low 6s, depending on your credit score. But it's shocking, and I just, you have to kind of educate the borrower in terms of, look, do you believe that we're going to have a recession? If they believe that we're going to have a recession, then we're going to be able to get out of this and eventually get something in the 4s to 5s. So it's a managing expectations type situation where it's shocking to the borrower to hear that number. A lot of them are being hurt by the high payment. It's hurting qualifications. So it's an education process, Rob.
What about on the refi side of things? Same kind of thing, or do people really like desperately want the money? Or
anyone that's refinancing now has to refinance. So they're like, we have a couple of scenarios where people have had a private loan and need to get out of it because their clock is up. So they're just having to, try to find the best day possible in the market. But anyone has a low rate and needs cash out, they're certainly better off doing an equity line, even at 8% prime, than disturbing a 3 or low interest rate first mortgage. You could just ride out the equity line until rates improve and then maybe wrap them up. But, depending on how much equity line they need, you have to look at the weighted average cost of funds. And even at 8% and interest only, if they have $400,000 first at 3.5, and they're doing a $50,000 second at 8, I would not disturb that 3.5% interest rate. That's malpractice, in my opinion, to take them out of 3.5 on a $400,000 loan to put them into 6.5 on a $450,000 loan. That's obscene. And anyone that does that should be disbarred. Do we disbar people? Take their license away.
To your point, Guy, hence why refis are 12% of the overall volume pie right now.
Yeah.
Yes.
So somebody just raised the question about here's a
buy downs.
Let's come back to the buy down.
Yeah.
But the question flashed up about unless you have FHA, MI involved. How does that complicate the first at whatever, refinancing them to a higher rate, yada, yada, or does it matter?
Are we talking about a pure FHA or?
Let me look at the question that popped up.
But I do want to talk about buy downs if you let me, when we're ready for that.
Somebody was in the chat saying, unless the current first is FHA with a high monthly MI.
Well, look, if you're at FHA at 3 and you have a 0.85 MI, you're at 3.85. So you're going to take them out of 3.85 and put them into 6 and 0.55 for MI? No, you're not going to do that. Just get a second mortgage. It's not in the customer's best interest for you, even though you're going to reduce the MI, you're going to jack up the first interest rate from a 3 something. Well, let's say they had 3 and that was 0.85. So it was 3.85 with MI. So now you're going to go to 6 and 0.55. So 6.55. No, it doesn't make sense. Unless you can get rid of the MI and get them out of FHA, maybe, but then you're still in the 6s. So I don't think that makes sense.
So what about Tom Amalfa is asking about, and obviously Fairway Independent has been a big success story, and that's where you are now.
Yeah.
What is, the buy down? Are you doing a lot of buy downs?
No, I don't like buy downs, and I'll tell you why. Number one, the buyer doesn't qualify at the start rate like they used to in the old days. Number two, if we had ARMs, which I'm a big proponent of having a 7-1 or 5-1 or 10-1 arm, we wouldn't need the buy down. Number three, you're taking dollars for today and just trading them off. Now, if the seller is crediting you for the cost of the buy downs, which most lenders or some lenders require, because then you get into that 3% situation where you get a non-QM loan. The buy that you're better off taking the seller's money and using that money to pay your non-recurring closing costs. Why? Because you're getting leverage on that money. When you're paying closing costs, you have to pay dollar for dollar. When I'm putting money down on a house, I'm putting up a nickel to borrow 95 or 20 cents to borrow 80. I have leverage on my money. Closing costs, I have to come in dollar for dollar. So I think that you're better off using that money to pay closing costs. I mean, it's sexy to say, okay, you're going to qualify at 4% in a 6% market. But when you peel back the onion and understand exactly what's going on, it's not so wonderful. The only time it's wonderful is if the buyer is going to sell the house or refinance and they get to keep the money that it was paid into the buy down account. But I'll tell you, I'm not a fan because you can't qualify at the start rate anymore. So bring back arms. Bring back arms.
What are you seeing in terms of borrowers and their credit ratings? Have you seen a deterioration of credit with potential clients, or has it been pretty steady?
You know, you get the standard deviation mix is what I'm telling you. You get at the high end, you get proportion of people at the high end, you get the middle big section, and then you get the tail where they have some lousy credit. But I will tell you, surprisingly, I have a borrower co-borrower buying a house. She had a 780 and he had a 560. And I was shocked.
Is he in the mortgage banking business?
No, he was not, unfortunately. He's 84 and kind of semi-retired. But here's the good news. The good news is that we were able to get the DU to work, I was shocked because we normally don't even bother if it's below 620. But for some reason we ran it and we were able to get them approved. Now the rate is high because of his low credit score, but I was totally shocked that that guy's credit ran and we got approved eligible with 20% down. So, I mean, I don't know what's going on there at Fannie and Freddie. I think it's a little wild right now. You know, we can talk about pricing and such, but getting back to your question, I don't think anything different than the normal distribution of credit scores. I will tell you that if someone has a good credit score, I just ran a guy who's buying a house with 5% down, and the PMI was 0.29. That's unheardedly low. That's amazingly low because 0.29 used to be the PMI when you had 15% down. So if you have good credit, I'll tell you that PMI, I was shocked to see that because on a 95, you know, you're used to be approaching like close to 1 or in the high 7s or 8s, but at 0.29, wow. But he had a good credit score. So for those folks, they're getting an advantage. For the folks that have credit challenged, you know, I'm not sure. We have to do a comparison between FHA, unfortunately, may be the place for them, especially now with the lower MIP cost.
Yeah, some of the chats, one of the chats saying that on that particular deal, you probably received an approval because they averaged the scores, but the pricing of the loan is actually based on the lower score.
Correct. Yeah, the price was high. There was no question about it. But I was, you know, from the old days, if it was less than 620, it's like, don't bother. But now, bother, try it, see what happens. But yeah, I don't know if they averaged it or what, but it worked. That's all we care about. It passed.
Right. So the week or two or three ago, the FHFA, Sandra Thompson put out a note saying hold off on the DTI pricing. We're gonna take that. We're gonna push it back to, sometime in later summer. And there's hope that perhaps the FHFA will back off that DTI based pricing entirely. Was that a big shot in the arm in terms of a loan originator such as yourself, or does it really matter?
Well, I think it helped out a lot. Listen, I think we're getting mixed messages from the FHFA. They talk about their mission to help people, first-time buyers, underprivileged buyers. And when you put in a constraint on the DTI, you're not helping out first-time buyers. You're not helping out minority buyers. It's impacting everybody. And my head is going to explode. And I'll tell you why my head's going to explode. The reason my head is going to explode is because I am all for actuarial-based pricing, risk-based pricing. What we're seeing here is policy-based pricing, okay? And we can probably have a whole show on this if you want me to come back. But, you know, when the risk-based pricing started, if you had a 680, you were in the top tier. Then it was 720, then it was 740. And now, you know, in the 740, you still had a half a point hit on an 80 LTV. Now they're taking it up to 780. So my question to Sandra, are these actuarially based, risk-based pricing? They knocked off second homes. They charge the same amount now as a non-owner occupied. So my question is, are those actuarially as problematic as a non-owner occupied, a second home? I don't know. I can't see the details, but I would love to ask somebody who had knowledge if that were the case. The same problem with first and seconds. You know, you're trying to help people, you avoid mortgage insurance, you hook up first and second, they're charging you because they feel there's more risk. Well, are those loans not performing to the level of that risk that they're charging you for? I don't know the answer to that. You're higher up the food chain than I am, and therefore you should be able to find out the answer. But
Are you talking to me or Tom or Sam?
I don't, all you guys. I'm just the guy in the field. I'm just the soldier in the field, and all I'm telling you is that, you know, if you can show me that the risk is there, charge for it. We don't want Fannie and Freddie to go out of business. We want them to stay in business. But if you want to affect policy with pricing, I have a problem with that.
Absolutely.
Yeah, I would.
On that note,
go ahead, Tom.
As you're with us on the rundown today, we've got Guy Schwartz with Fairway Independent with us. Guy, great points too. I think the feedback was very similar from our collective membership, the Mortgage Collaborative, at our most recent conference, just feeling like these LLPAs fly in the face of that duty to serve and create more affordable lending out there. Rob, I don't want to cut you off here. It sounded like you had a question. I've got another two. Okay. Guy, I'm kind of curious as well from your perspective, you know, for the originators out there, maybe under your purview that may not have been in this industry that long, how are they dealing with those conversations with consumers right now that, or just for their own experience, I should say, where they've been used to maybe selling it a threes rate environment, haven't had past experience when rates were in the sixes and sevens. What do you advise on there as far as the kind of coaching goes to your LOs?
Well, that's a good question. And when you show people factual information, as opposed to advertisements in the newspaper, you gain more credibility. So for instance, we used to have people calling me and saying, oh, I saw a rate in the newspaper on Sunday and it was X. And I said, okay, here are three things that are going to happen when we call that lender. Number one, it's a 15-day lock. Number two, that was Wednesday's price. Number three, they're not going to answer the phone. And 99% of the time, when we did that exercise with the customer, I was right. It was Wednesday's price, it was 15-day lock, or nobody answers the phone. But getting back to how you educate the customer is critical. So I take them right to Yahoo Finance, and I show them the 10-year treasury. And here's exactly what I say. The 10-year treasury is related to how mortgage bonds are moving. Now, I can't tell you that a 3.5% bond is going to equal X price in mortgages, but I can tell you if we go from 3.5 down to 3.35, we're now moving the needle in mortgage bond pricing, which helps interest rates. So I let them watch the real barometer, or as real as they can get. Now, I have MBS that I watch, and I can see the 5% and the 5.5%, but they're not paying for the subscriptions. But they can certainly see the 10-year treasury for free. And as I mentioned, I tell them, look, just watch the movement of it. Not 0.001 is not moving this. But if you see like 0.15, 0.125, now the needle is moving either up or down. And I said, you can watch CNBC in the morning while you're doing your stretching. You can go to Yahoo Finance and look at the 10-year treasury. So I try to get them off of advertisements, which we know are mostly BS, and we don't know all the details of the advertising in terms of how much prepaid interest they have in there, which affects the APR. So if you try to do an APR comparison, I teach this in my continuing ed, and not to get very gritty on technical details, but when you're quoting APR, prepaid finance charge is one of the components. Now, you, Tom, may quote one day, and I may quote 15, and Rob may quote 30, and all our fees are identical, but our APRs are different. And we're all right. We're all of us are right. So you will look better because you have one day of prepaid interest. Rob will look not as good, and I'll look in the middle. So it's an education process when people are trying to compare apples and apples or apples and oranges. But I just try to educate them and have them watch the 10-year treasury. And I also have, as part of that MBS Live, we send out that newsletter on Friday, which people like, and it keeps them informed about what's going on. But you know, if they're telling you so-and-so's offering that rate, there are times if they get an LE or fee sheet even, you have to say, hey, that's a great deal, take the rate. And that's tough to do. It's hard to do. But if some, you know, internet provider that doesn't have any brick and mortar and is giving them a low ball rate, well, you can try to match it if your company will let you, but sometimes you just have to say, hey, take it. However, I want you to do me a favor. If something starts to go sideways, call me. Make sure you leave that door open so they don't feel embarrassed to call you if that deal starts to blow up on them, or if what they thought they were getting is not what they're getting. Did I answer your question? I hope.
I think that's a very good answer for originators who are new, relatively new. It's basically, you know, sales 101. And I tell people during the pandemic, if you were a loan originator, all you had to do was step outside and hold the basket out, and loans would rain into your basket, and you'd take them into the processor and let them deal with it. But now, you know, every deal is precious, and every potential borrower is precious, and the ability to sit there. And I'm a big proponent of just presenting the facts, being straight. And that's what I try to do in my commentary, for example, is here are the facts. I'll throw some opinions in once in a while, but here are the facts. Make use of them however you see fit. And it sounds like you would advise a new originator to do the same with their potential clients.
Well, I want to add on one more thing to that. You know, there are a lot of coaches out there and vendors that want to sell you scripts or things like that. And I hate scripts. Scripts are for robots and actors. What you should do if you're new or relatively new is you should educate yourself so that you don't have a script and have to answer questions in a linear manner. Just like those telemarketers, you ask them a question off their script and it blows their brain up. By getting yourself educated, you can start at the back end of the presentation, the front of the presentation, the middle of the presentation. As long as you cover the entire presentation, you're good. So I would say don't be scripted, be knowledgeable, learn your products, learn the process so that you can describe it and answer questions for any consumer and not have to sound like a robot.
Great words of wisdom, everybody. Welcome to the Rundown. Got Guy Schwartz with Fairway Independent with us today. Some good comments in the chat just based off your feedback, highlighting educating the borrower. Folks loving the index and the banner at mortgagenewsdaily.com, the weekly rates from Freddie Mac on their site. A couple links in the chat to that. And kind of on that note, I haven't seen the movement in the 10-year treasury today, but a lot of feedback on my feeds yesterday just about it trending downward, kind of in reaction to the Fed's announcement. Chairman Powell, quarter point interest, kind of something we thought we were going to see out there, just in reaction to kind of volatility in the banking market over the last 2 weeks, but at the same time still wanting to head off inflation. Rob, Guy, I'll lean on you guys. Have you seen any updates today as far as the 10-year treasury goes?
I haven't. I'm trying to get it going, but there's a problem with MBS Live today. Their servers.
Yeah, I don't think there's much going on there, Tom. The
3.38.
Okay. Yeah, I mean it's very low. And Guy, you know what I think about predictions and interest rates and so forth, but you know, rates are going to do what rates are going to do. Yes. And what was interesting about your discussion about how you would coach or how you would teach a new originator, has very little to do with A, predicting rates, or B, rates, period. It's all about teaching them. I mean, yeah, you can watch the 10-year, but it's about teaching them how to help themselves and the process, rather than, well, if you think rates are going to go down, then why don't you hold off, locking
Right.
or hold off buying. I like to say I've never heard a loan originator tell that to a borrower.
Well, you get into that let's make a deal conversation, which is, are you happy with the rate today? Do you want to lock? Do you feel like your crystal ball tells you rates are going to go down and maybe we can float? And then they ask you, how long can I float to? And it's like, well, maybe about 7 to 10 days before you want to close. So that's always a tough situation. And if we tell them what to do, they're going to be mad at us, because if we lock and rates go down, they're mad at us. If we tell them not to lock and rates go up, they're mad at us. So you make sure you have to put that decision on the customer. And again, it's just a question of educating. But I'll tell you one thing that's very helpful in that whole rate lock discussion is having a target, a trigger point. So in other words, look, when the Treasury hits 3.35, we're going to lock. Boom. Okay. So now the Treasury hits 3.35. There's no discussion. You give me permission to lock you when the Treasury gets to that rate. So otherwise, they're kind of just floating up there and out there. But if you hit, it's like a stop order or whatever they call it in trading stocks. When you get to a certain point, boom, we'll lock it in. That could be helpful.
Guy, do you have your borrowers opt out of what is it? Opt out of so they don't get trigger.
Yeah. So here's the thing. This is a big question, which probably could be like 3 episodes. The CFPB is concerned about people's right to information and make sure they're getting a good deal. And how could this possibly be legit that I'm applying for a loan? It's none of your damn business. Why are you calling me up? Yeah, we just had a borrower that started getting like bombarded with phone calls from opt-out from those pre-screen things. Why is that still legal? I would like to know that. It's none of your business if I'm getting a loan. Why are you calling me?
And I actually heard some feedback at our most recent conference, originators pulling just 2 of the bureaus there to pull in the info they need, but at the same point, avoid that trigger lead out there for those solicitations.
Yeah, some people say, don't put the phone number or their email address in your LOS system, and then pull the credit. I don't know if the information's already in the file, they're still going to get phone calls. But so I'm not sure what's triggering it, but it is a pain in the neck. It doesn't seem like it's the right thing, and I don't know why the CFPB has not gotten after these people. But what can I say? But I see Steve Richmond. I want to give Steve Richmond a shout out. I'm his raving fan.
Huge fan of Steve Richmond as
Yes.
well. And,
frankly, I'm surprised, Guy, that Steve Richmond. I asked somebody about Steve. He's, like I like asking somebody about Zeus, right? It's like you don't want to actually talk to Zeus. You want to ask people about what's going on up there in the heavens. I'm surprised Steve has time to tune into the show, because I hear he's giving like 4 or 5 speeches a week all over the nation again.
Well, he used to be known as Mr. PMI, but I don't know what is he doing now. He's not with mortgage insurance anymore, I don't think.
Steve, you're in the chat. Chime in with the latest and greatest. I remember meeting you 10 years ago at a branch at First Federal Lakewood. You came in and told us all about the cool latest apps out there, and he says it's all about me now. We're going to turn this into the Steve Richmond show.
It's all about me. I tell people that too. Actually, Steve and I go back a ways, and I like Steve because he actually tells audiences, hey, if there's one thing you need to read every day, www.robchrisman.com and call it a day. But
I'm a faithful reader.
Tom, the chats keep going here. Should we go longer than 30 minutes, a few minutes, or should we cut it off here?
I'm in your world, Rob, as always. If you got a few, I got a few, but we'll try to keep you guys not too long here. Appreciate the commentary out there. By the way, I am drinking water today, so Rob can talk about the Fed or the FDIC as much as he wants to, and I will stay sober this afternoon, but I appreciate the commentary from last week. My liver did survive our little interactive drinking challenge, but thanks for the positive support.
Right, Guy. So Guy, can you read the chats at all?
I see the chats now. I see the chats now. Yeah. Steve Richmond wants us to keep talking about. Okay, Steve, you've had your 15 seconds of fame.
No, there's one from Chris about doing
yeah, I'll read it off real quick.
Soft pulls. Guy, do you use soft pulls? Do you utilize those so that the borrowers don't get the phone call from the trigger lead system?
No, but you know what I've been doing is if they, I don't know if the soft pull, depending on how much information you put in on the soft pull, might cause a trigger lead because they're going to see who's initiating the inquiry. So I'm not sure if that works. So
I've heard that it works.
Was that?
I've heard it works.
Yeah.
Yeah.
Go
ahead, guys. Sorry.
It's right. What does it say? The law says sharing info on the credit report is legal. Therefore, they would have changed the law as it is already written. Yeah. Okay. Well, I don't know how trigger leads ever got legal, but if it is, it is, and it seems like an invasion of your privacy to me. But
yeah. So, Guy, any closing? You've given some great tips and advice here. Any parting words as we wrap the show up in terms of the environment? And I tell people, I know that the NBA just scaled back their estimate for 2023. They brought it down to 1.8 trillion. I think it was up near 2 or maybe 2.2 trillion. So they're reducing that. And I tell originators, when I go to a shop because management brings me in to give a speech or a regional organization or whatever, say, somebody's got to do $1.8 trillion worth of loans. It may as well be you. It's not all going to be, United Wholesale or Rocket or Chase and B of A or US Bank. What keeps you going, and what do you tell your fellow originators about the current environment?
What keeps me going is that learning, because every day is different. And I'll just give you one quick example. Number one, we had this lady that we thought was a no cash out refi, and she got a DU and a PIW, and it was all good. And then when we found out, oh no, it's a cash out refi, we ran it out of cash out refi, and they didn't like it, either DU or LP. And I spoke to the underwriter, and she says, yeah, you're never going to learn once you think you're near the brass ring and you've got all knowledge, they're moving the brass ring. So the fact that things are changing constantly in this industry, and underwriting guidelines and products, it's keeps you fresh. But what would I tell a new me? What do they call it? Positive affirmations of passion, action, and discipline. You got to love this. If you don't love it, you're not going to be successful, period. Number one, you got to do something, whether you're going to go out in the field, whether you're going to do videos. A lot of people are doing videos, and I'm not saying that that's bad. I brought up the old way. We used to go out to real estate offices and deliver flyers in the in basket and go to open homes. I think open homes is a great place to go to meet real estate agents because they've closed the offices. They don't want you in there. They throw you out. So how do you meet real estate agents? You go to open homes. It's a great way. Now, during COVID, that was a little harder, but now things are back to somewhat normal. You have to have passion, action, and discipline. It's raining, I don't want to go out in the field. No, get your ass out in the field. You got to go. You have to be consistent, have them see your face, have them trust you, leverage every deal, call the listing agent, and do what you say you're going to do. And I'll give you my 11 herbs and spices secret to success, because we deal with a commodity product. Intuit has money, United Wholesale has money, Fairway has money. All our money is green. What separates that money? The delivery. The delivery. So in other words, I say to real estate agents two things. This is the $1 million. This is the reason to buy. Number one, we're going to return your phone call. Number two, we're going to give you a straight answer. And they're shocked. When they hear that, they're shocked. Why are they shocked? Because there are so many people just talk, and not doing anything. And it's okay to say, I don't know. And it's okay to say, I can't do that. Because you only get one chance for your reputation. So keep your reputation. Frank Perdue sold chickens. He made it a Purdue chicken, which is special. So make yourself special. Make sure you have a reason to buy. I'll leave it there.
Yeah, I love the
Thank you very
11
much.
herbs and spices in there. And
Yeah.
some commentary in the chat as well, just showing a lot of love to soft pulls. When soft pulls do not get triggered, soon you'll be able to run Freddy with the soft pulls. So some interesting feedback from the audience. As we look to wrap up today, Guy, Rob, any good plans in store for the weekend ahead?
I got to do my taxes this weekend because I'm going to Mexico the week after that. So that's on my that's on my to-do list.
That sounds like a lot of fun.
Yeah, it's not too bad.
I get to go to a Warriors game tonight.
Lucky you.
Nice, who they playing?
Oh, shoot.
Come on, die hard.
All right, hold on. I'll tell you because
While Rob pulls it up, I'm going to be celebrating a 40th birthday of a friend tonight, and then taking a trip down to Louisville to take a look at sites for TMC 24.
Oh, the Philadelphia 76ers, Rob.
yeah, they're playing Julius Irving's 76ers.
Well, I had a great time. I hope that you guys invite me back and we can talk about some more interesting topics.
Absolutely.
You bet. Thank you very much, Guy.
Appreciate having you.
I appreciate being here. Thank you. And I hope the audience appreciated me as well. And I thank you very much.
Absolutely.
All right,
Well,
guys.
everybody, have a lovely weekend. Reminder, TMC members out there, last call, $5.95 early bird for Nashville. Got to get the shameless plug in. Have a good weekend, everyone. Talk soon.
All right. See you later.
Kirk out.